So I just want us to look at multi-factor models, which are basically part of the analysis of the risk, which we are encountering under the portfolio theory and analysis. And we are just looking on a model which basically employs multiple factors in its calculations. And basically, it is normally used to explain the market phenomena or equilibrium asset prices. And when you look at it, there are a few things that you have been coming across over the years. For example, you have, or you might be have come across the arbitrage pricing model, which basically is part of the multi-factor or is part of the type of the multi-factor models. And we know very well that the arbitrage was basically developed due to some of the limitations of CAPM. We know very well that one of the key things is that the CAPM basically is used to measure the systematic risk, which which is basically measured using the beta factor, the beta coefficient, which you were able to analyze last time. So in this case, we are not going to be looking on some things which we have never had before, but we have to be knowing that these arbitrage pricing model, it normally assumes that there are several factors which are going to be influencing the return of the equity. So when you go back, when we are going to be analyzing this, we are going to be evolving around the measures which are used on the environment of risk. And those are the things that I'm certain you have been going through over these units. Now, let me just start by giving a definition of a multi-factor model. And I have said it's just a financial model. It's a financial model. It is a financial model. It is a financial model that employs normally employs multiple factors. Normally employs multiple factors, right? It normally employs the multiple factors in the calculation. Normally employs the multiple factors in its calculation to explain the market phenomena. To explain the market phenomena, all equilibrium of assets, equilibrium of asset prices, equilibrium of the asset prices. From there, we are going to be looking on, we are saying that there are three types of the multi-factor models. There are three types of multi-factor models. When you look on number one, right, I have said we normally have arbitrage pricing model. Arbitrage pricing model, it is normally called APM, right? And I have said it is just what this model was developed. This model was developed due to the limitations of CAPM. They were developed due to the limitations of CAPM. And we are saying that it normally assumes that there are several factors which influence the return of security, right? I have said it assumes that there are several factors. There are several factors, which influence the return of security. What are some of the factors which normally influence the return of security? I can give an example of inflation. I can give another one for interest rates, right? Interest rates. You can talk about the government policies, among other things. So we are saying the model is based on the following assumption. Is based on the following assumptions. The model is based on the following assumption. Number one, the capital market, we are saying the capital market is perfect and efficient. The market is perfect and efficient. Number B, you can also talk about investors. Investors prefer more returns. Investors prefer more returns. Number C, the return of equity, or the returns of security, the returns of security is generated through the return of security is basically generated through continuous buying and selling. Continuous buying and selling of securities. Those are some of the assumptions which are basically under the model. Now, in this case, number two, which is our number two here, we are discussing about Farmer French model. Farmer French model, and we're saying this model normally considers three factors. It normally consider three factors. One of the key factor, right? Number one, you normally discuss about market factor. Number two, it normally considers size factor. Then number three, right? We are saying it normally considers the value factor. Those are the three things which the Farmer French model normally considers. Number three, we are discussing about Pastor-Stamble model. And we are saying this model normally considers Farmer French factors. Farmer French factors together with liquidity factors. So it means that when I'm going to be doing when I'm looking on the Pastor-Stamble model, it means that it is going to be considering the three factors under the Farmer French, which normally include the market factors, size factor, value factor, together with the liquidity factors. So how do we normally get our expected return? How do I normally get my expected return? I can just be able to say, when I'm using this model, to get the expected return of our portfolio, right? To get our expected return, we normally take, right, the risk-free rate of return, right, plus the expected return of the market, to say one, minus the risk-free rate. Then we multiply by beta coefficient 1 plus, because it might be we are dealing with more than one factor. Then number two, we are looking on the expected return of the market 2 minus the risk-free rate 2, the risk-free rates. Then we multiply by beta coefficient 2 plus the return of the market 3, right? Minus the risk-free rate. We multiply by beta coefficient 3. We go all the way to Bn, right? We can be able to discuss about the return n minus the risk-free rates all the way. So it means if I'm dealing with more, that is how I'm going to be factoring. Sometimes the examiner might be giving already the solution for this. It's normally called risk premium. That one is normally called the risk premium. So already when the examiner has given me the risk premium, it means I'm going to be taking the risk premium given into the respective factors. Then I multiply by the beta coefficients provided for each multiple factors, To understand this better, I just want us to start by looking on November 2020. November 2020, we look on question number 2B. November 2020, question 2B. November 2020, question 2B. Let us start by looking on that question. So let us look on this question. (2020) here. Someone is going to start reading for us. So we are looking on which question here. We are discussing about this question. Right. We are discussing about question 2B. Someone to read for us, please.
I'll read.
Okay.
The estimated factor sensitivities of Diamond Limited to Farmer French factors and the Pastor-Tambo model factors and the risk premium associated with those factors are given in the table below. So we have factor sensitivity and risk premium, market factor, size factor, value factor, liquidity factor. The treasury bill rate is 5%. The required rates using the Farmer French model, and 2, the required rate of return using the Pastor-Tambo model.
Thank you so much. When we are given this question, you just need to be understanding what out of each model, what normally entails. And I know very well that when I'm dealing with Farmer French model, to normally consider the market factors, the size factor, together with the value factors. And I know very well the formula to get the expected return under the multi-factor models. I know very well that I have to be factoring the risk-free rate of return, which is given in this problem, the treasury bill rate, which would be 5%. So when you go to do your solution, this is what you're supposed to be doing. This is what you're supposed to be doing here, right? So in this case, I know very well that what I need right now, I just need to be writing my formula, which is above there. I can take the risk, the expected return, which I take the risk-free. Then I add, I can see we are given the risk premiums. So the risk premium, then you multiply by beta coefficient 1 plus the risk premium 2. Then you multiply by beta coefficient 2. Then number 3, we take the risk premium. The risk premium 3. Then you multiply by beta coefficient 3. So already I know very well, I'm going to be starting by doing the Farmer French model. The Farmer French model. And in this case, I can see to get my expected return, I just need to be taking the risk-free rate. I have said it is given as a treasury bill rate, which is 5. So I just need to write 5 there, plus the risk premium given under the market factor. Since the Farmer French normally considers the 3 factors. So the first one is 5. 5. When I put in brackets, I multiply by my first factor sensitivity, which is 1.05, plus the risk premium 2, it is 2.50. I multiply by negative 0.60, plus the other one will be 4.5. Then I multiply by 4.5. I multiply by 4.5. 4.50, I multiply by negative, sorry, it should be negative 2, negative 0.20. So how much am I getting here is my expected return. You just need to put this data on your calculator straight away, and you'll be able to get the solution for the question. So this one will be, let me first take the additions. So it will be 5 times 1.05 plus 2.50. I multiply by negative 0.6, right? Plus 4.5, I multiply by negative 0.2. Then I add 5. And I can see I'm getting, how much are we getting?
I have something to say.
Sorry?
The second one,
Mm-hmm.
the second sensitivity is 0.65, not 0.60.
Yes, thank you. It should be 0.65. Thank you. Thank you. So I'm going to be taking 5 times 1.05 plus 2.5 times negative 0.65 plus 4.5. I multiply by negative 0.2. Then plus 2 plus 5. I'm getting 7 points, right? 7.725. 7.725. And in this case, remember number 2, we have said, when you are dealing with the Pastor-Stambold model, right? I have said, consider the factor French model together with the liquidity factor. So when I'm going to be getting the expected return here, I just need to say, let me take the factor French model plus liquidity factors. Liquidity factors. So in this case, it is very simple. It means I just need to take 7.725 with the solution for the first requirement, then plus the factors, the risk premium for the liquidity factor will be 4.50. Then I multiply by 0.2. 0.20. So plus I open my bracket, 4.50, I multiply by 0.2, right? I close my brackets. I'm getting 8.625. I'm getting 8.625. It should be in percentages. It should be in percentages. That is how you normally do the multi-factor models. That is how you work with those problems. Now, I just want us to look on a different question, which is tested at a different dynamics, right? A different question with a different dynamics, but I will be able to give you an illustration before I shift. November 2019, it will be our assignment for this. I'm discussing about November 2019 question 3C. November 2019 question 3C. Nothing much I'm going to be expecting from you rather than what we are doing right now. Nothing much I'll be able to expect from you rather than what we have worked on. Now, I just want to look on a different question, which already is under the portfolio theory and already matches what we have already done. So I just want to analyze the question, and we see whether we can be able to recall what we have done. November 2020, right? Question number 3B. This sitting was having 2 questions from the portfolio aspect. So when we are looking on this question, let me just go there. We look on the question. I think Anne can be able to read for us. Anne, can you be able to read for us? Sarah?
The shareholders of Mali Investment Holdings have for the last 2 years managed to save an accumulated fund of 15 million available for investment. A financial analyst they hired to appraise some possible projects they can invest in have availed the following information. We have project PQRS, whereby for project P, the initial cash outlay is 9 million, then expected return 12%, standard deviation 2.5%. Q, we have initial cash outlay 7 million, expected return 21%, standard deviation 1.8. We have project R, whereby the initial cash outlay is 6 million and the expected return is 16% and standard deviation 2.3%. Then we have S, whereby the initial cash outlay is 8 million, expected return 14%, standard deviation 1.6. The covariances between the various project contributions are as follows. Project PQ, where the covariance is negative 3.1, PR, where covariance is 1.3, PS, where covariance is negative 4.1, QR, where the covariance is 1.5, QS, where the covariance is 1.7, RS, where the covariance is 2.7. Additional information. The management is planning to invest by pairing the projects. 2, the maximum capital that can be invested is the accumulated fund as shown above. Number 3, any paired project is mutually exclusive and none of the project is divisible. So required, for each possible project combination, calculate the expected return, correlation coefficient and standard. Just a minute. But it happened to my screen.
Sorry. 2, the requirement part 2, we are being told to advise the shareholders of Mali Investment Holdings on the optimal project pairing based on the mean variance criteria. They will be able to say, I can be able to say that every time you see a project which is having a negative covariance, we know that those pairing can only be rejected. We cannot be able to undertake those projects. And also the explanation part number 3, when we are discussing about the capital ratio, that is just a capital ratio where we are discussing about divisible and indivisible projects. I remember when we were looking on that, we said the divisible projects are the projects which can be undertaken altogether, whether part or wholly. Indivisible projects, we say these are the projects which cannot be undertaken apart. They must be taken fully, or you can't take them. That is what we discussed when we were analyzing the capital rationing. Now, when I look on part 2, we are being told the maximum capital that can be invested in the accumulated fund is shown above. And now you can see the management is planning to invest by pairing the project. So I can see the information provided there with the covariances. We have some pairings given, and then we have our covariances. So when you look on this pairing given, right, all the projects with a negative covariance are rejected. So when I look on them, every time I'm going to be doing my analysis, I'm not going to be factoring those projects, those pairing, right? So it is just as simple as just ignore all the projects which you see, the pairing which have a negative covariances. Now, where do I have to start? 1, I can see the requirement of the question is, can we be able to calculate the expected return? We know very well, when we are calculating the expected return, we normally take the weight of the asset, then we multiply by the summation of a return of that asset. So in this case, because we are doing a comparison, and we know that the portfolio is just a combination of the assets, right? To give the maximization or to be able to give you the maximum return, then we have to be firstly working on the computations of the weights. So let's start from there. Let me start from that point. Let me start from there. So in this case, when I look on these combinations with the positive covariances, right, I can see my first project will be PR. PR. So the biggest question is, how am I going to be getting the weight? We are going to be looking on the initial outlays provided by the examiner for each project. And I can see the initial outlay for P is 9. Let me talk about 9, and I limit those shillings to millions. So it will be 9, and then for R will be 6. This totals to 15, right? I have said when I look on the initial outlays are going to be assisting me to calculate the weight. So the amount required to undertake a project P is 9 million. The one to undertake project R is 6 million. So the total investment which is needed under the pairing is 15 million, right? When I look on the second project with the positive covariances is QR. When I look on Q, right, the initial outlay required is 7, and then for R, when I look at it, is 6. So when I look on that summation, will be 13. Now, when you go to another pairing, I can also see we're going to be having R. Is it R? No, QS. I can see we have QS after the QR. So our QS will be, I can see Q is 7. And our S is how much? 8. This totals to 15, right? Then the last one, you can see the pairing is RS, right? And then the initial outlay for R is 6. And this one is 8. You can see the exact pairing, the initial outlay might be equal to what we have, 15 or less, right? You can see under this QR, we are going to be having a surplus under the capital rationing. And also you can see here, we are going to be having a surplus of 1 million, right? There is no any project which requires an initial of 1 million. So we are going to just to be leaving it. It's either we undertake it wholly or we leave it. And because of the additional information number 3 given there. So in this case, I can be able to get the weights, right, for each project. You can see the weight is going to be computed by taking 9 divided by 15. You can be able to get the weight of P. And also I can take 6 divided by 15. I get the weight of R. So in this case, I can just be able to reduce my work here. And I say for P will be 9 divided by 15. And then I'm going to be getting here. Then for R will be equal to 6 divided by 15. Now, when I look for the Q, for Q will be 7 divided by 13. I get it there. Then for R will be 6 divided by 15, 13, sorry, we are going to be getting it there. Now, when you go to the QS, we are talking about for Q will be 7 divided by 15, right? And then we have for S, which equals to 8 divided by 15. Then for R, I can be able to see will be 6 over 14. And then for S, will be equal to 8 divided by 15. 8 divided by 15. So in this case, I can see, I can be able to get the weight of each project we are undertaking. So I start with the first one, 9 divided by 15. This should be 0.6, right? The other one is 6 divided by 15. 6 divided by 15, getting 0.4. The other one will be 7 divided by 13, getting 0.5, 0.54. Then the other one will be 6 divided by 13, getting 0.46. And the combination of the weight should be equal to 1. You can be able to see mine is I'm equating to 1. So 7 divided by 15, I have said I'm going to be getting 0.47. Then the last one will be 8 divided by 15, getting 0.53. Then the last one will be 6 divided by 14, getting 0.43. Then the other one will be 8 divided by 15, and I'm getting 0. How much is this? 0.5.
8 divided by 14.
Sorry?
It should be 8 divided by 14.
14. That is why I'm wondering why it is not totaling. Thank you for that. It should be 14, and it should be 0.57. 0.57. So when we are looking on the computation of the first requirement, Examiner wants us to get the expected return. Expected return of the two pairings. So to get the expected return, we said, right, let us take the weights, then we multiply by the summation of our return. So in this case, when I look on the first pairing, it is PR. So it will be the weight of P times the summation of R over return P plus the weight of R, right? I multiply by the summation of return R. So in this case, it will be, right? How much is this? I'm just going to be taking 0.6. I multiply by how much is the expected return? I can see the return provided there is 12, right? Is it 12? Yes, it should be 12 plus, I can see for W, it will be, right, 0.4. Then I multiply it by, I can see the, for R, it will be equal to how much? 16 here. So how much? 0.6 times 12 plus 0.4 times 16. I'm getting 13.6. 13.6%. Now, when I look on the other one, right, we are looking for the second pairing, which is for the Q and R. So I can see for the QR, I'm going to be taking the weight of R, which we are of Q, which I've gotten 0.54. I multiply by the return given by the examiner there. Our return for Q is totaling to how much? I can see 21. Plus, I can see we are discussing about 0.46 times the return of R is how much? I can see 16. So how much are we getting there? 0.54 times 21 plus 0.46. I multiply by 16 and getting 18.7%. Now, when I go to the third pairing, QS, I'm going to be taking the weight of Q. So in this case, under this one, it will be 0.47 times the return of it, which is 21, plus the other one will be 0.53 times the return of S. The return of S, when I look on the question, will be 14. So 0.47, I multiply by 21, plus 0.53, I multiply by 14. I'm getting 17.29%. 17.29%. Then the other one will be RS. And for RS will be equal to 0.43. I multiply by 16 plus, right? We are discussing about 0.57. I multiply by, for S is 14. So how much it is? 0.43. I multiply by 16 plus 0.57. I multiply by 14. Getting 14.86. 14.86%. So that are the things which already, I know I have already gotten the expected return. When I look on the requirement number 2, after the expected return under the note number 1, examiner is asking for the correlation coefficient. Correlation coefficient. Examiner has asked you to get the correlation coefficient. And in this case, we know very well, to get the correlation coefficient, I can just start with the first project pairing. I can just say, to get the correlation coefficient of project pairing of P and R, right? We are going to be taking what? We can talk about covariance of P and R. You divide by, we are discussing about the standard deviation of P. We multiply by the standard deviation of R. So in this case, I can look on whether the examiner has given me the covariance, and I can say yes. Because already I have the covariance of P and R, which is 1.3. We divide by the standard deviation given up there. For P is 2.5. For P is 2.5. I multiply for the R. R is how much? We are given 2.3. So how much it is? I just say 1.3 divide by, I open by brackets, 2.5. I multiply by 2.3. I'm getting 0.23. I'm getting 0.23. Now let's move on the next pairing. And the next pairing we are discussing about QR. So to get the correlation coefficient of QR, just look on the covariance of QR, which we have been given there, which is equals to 1.5. We divide by the standard deviation of Q, right? The standard deviation of Q. The standard of Q is 1.8. I multiply by 1.8. I multiply by the standard deviation of R, which equals to 2.3. 2.3. So it will be equal to 1.5. I divide by 1.8. I multiply by 2.3. This equals to 0.36. Then the third one will be the correlation coefficient of QS. Now, just look on the covariance of Q and S. Is it QS? Is it QS? Right? Is it QS? For the QS,
Yes,
I can see
yes.
is 1.7. Divide by, right? We divide by the standard deviation for Q, right? The standard deviation for Q is 1.8. We multiply by the standard deviation of S, which is 1.6. Which is 1.6. How much are we getting? 1.7. I divide by, I open my bracket, 1.8 times 1.6, right? Close your brackets, getting 0.59. Now from there, we go to the last one. The last one, we are looking on the correlation coefficient of R and S, which will be equal to, right? We are looking on 2.7. For R, we are looking on 2.3 times for S, which is 1.6. 1.6. How much are we getting here? 2.7, you divide, open your brackets, 2.3, right? I multiply by 1.6, getting 0.73. 0.73, 0.73, 0.73. That is how you normally get the correlation coefficient of those pairing. Then I can see still the examiner is asking you, and you get the standard deviation. Get the standard deviation of the pairings. So when you look on the standard deviation of these pairings, how am I going to be doing it? Let me just write my formula here. The standard deviation of these pairings. Let me just get the formula. So let me start with the first one. To get the standard deviation of two pairings, I can see we are discussing about P and R. We normally take the root of, right? I think under this question is where some of the students were having some needed some clarification. When I write my formula like this, right? Squared of P. This means it's a variance, right? It is a variance. It means if I had the standard deviation, I square it to get the variance. If I have a variance and I want to get the standard deviation, I root it. I root it, right? Then I multiply by, that is the standard deviation, right? I multiply it by weight squared of P plus the weight of R squared. We multiply by the standard deviation. Is it the standard deviation squared to come up to a variance, right? Then we had, right, the weights. The weight of W, 2. It should be 2. Weight of P, right? We multiply by weight of R. Then we multiply by covariance of RP. RP or PR, right? I think it should be like that. So in this case, the pairing does not have any problem. So let me interchange here. It should be PR. So in this case, I just need to say, let me start by working on this now, right? So to get the variance, I just need to take the standard deviations given in the question. Examiner has already provided the standard deviation there. So I just need to take for P, which is 2.5 squared to get the variance. I multiply by the weight. The weight I was able to get for P, which is 0.6 squared, plus the weight of R, which we were able to get 0.4 squared. Then I multiply by the variance of R, which I just need to take the standard deviation of R, which is 2.3, I square it, plus to the weight of a P, which we have said is 0.6 times 0.4, right? Then we multiply by the covariance. The covariance of these two, right? We are given 1.3. 1.3. How much is this? How much is this? 2.5 squared. I multiply by 0.6 squared plus 0.4 squared. I multiply by 2.3 squared. Okay. Plus 2 times 0.6 times 0.4 times 1.3. The root of my answer should be the standard deviation of the pairing, which comes to 1.929. 1.929. Then the other one will be the pairing for the other pairing, which is it QR? It should be the standard deviation of the QR, which will be equal to the root of what? Right? I can see the weight of a P of the Q, sorry. The weight of Q here will be equal to 0.54 squared. I multiply by, right? We are discussing about the variance. So the standard deviation of Q, I can see examiner has given you 1.8 squared plus the weight. Now we are looking on the weight of R, and our weight for R should be equal to 0.446 squared times, we are looking on the variance for this. So I just need to look on the standard deviation, which is 2.3 squared plus 2 times 0.454 times 0.47. We multiply by covariance of the two pairing, we should be equal to 1.5. 1.5. So how much is this? So it will be equal to 0.54 squared times 1.8 squared plus 0.46 squared. I multiply by 0.23. This is 0.23, no. I multiply by 2.3 squared. I add 2 times 0.54 times 0.47 times 1.5. The root of my answer should be equal to 1.68. It should be 1.68. 1.68. 1.68. Let us go to the third one. The third one, I think Mwende is able to catch up with us. Just greet us. You tell us you are okay. Right? The other one will be the standard deviation of QS now, where I'm supposed to be getting, I start with the weight. The weight of Q. Our weight of Q in this scenario, in this combination was 0.47 squared. I multiply by the variance. I say the variance, you just need to take the standard deviation and you square. So for Q, it was 1.8 squared plus, right? We look for S now, right? When I look for S here, was 0.53 squared, that is the weight, times the variance for S. I just take the standard deviation of 1.6 squared. 1.6 squared, I roots, right? Plus 2 times the weight, 0.47 times 0.53 plus the covariance now of the pairing. The covariance of this pairing of QS should be how much? That pairing should be how much? QS is 1.7. 1.7. So how much am I getting down here? There should be multiplication here, sorry. So just take your calculator, 0.47 squared times 1.8 squared, right? Plus 0.53 squared times 1.6 squared plus 2 times 0.47 times 0.53 times 1.7, right? The root of my answer should be 1.51. 1.51. Then let us go to the last pairing. Let us go to the last pairing, sorry. Someone speaking? When they want to prove us, you want to tell us she is okay. So when they to do the last one will be to get the standard deviation, of RS now. We are going to be taking the root of what? We are going to be taking the root of, I can see the weight of R is 0.43 squared. I multiply by, right? For R, I can see the variance should be 2.5 squared. I add the weight of S. Our weight of S will be how much? 0.57 squared times the variance.
R is 2.3.
Sorry?
R, the standard deviation of R is 2.3, not 2.5.
The standard deviation.
Yes, of R.
2.3. Thank you.
No, yes.
2.3. I'm just copying wrongly. The other one will be for S is how much? I can see for S is 1.6. Right? Then we add 2 times 0.43 times 0.57. Then I multiply by covariance of how much? The covariance of the last pairing should be 2.7. 2.7. So how much is this? How much is this? So it should be 0.43 squared. I multiply by 2.3 squared plus 0.57 squared times 1.6 squared plus 2 times 0.43 times 0.57 times 2.7. The root of your answer should be giving you 1.77. 1.77. Those are 12 marks. 12 marks. 12 marks are what? Then number 3, we are being told, advise the shareholders, the requirement part 2, advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance criterion. So in this case, part 2 now. Part 2. So examiner is asking us to be able to look on the project with the lowest standard deviation. Because we said the higher the standard deviation, right, the higher the risk, right? So in this case, we have been told a device based on the mean variance criterion, which we are able to do here. And I can see the project QS, which is having 1.51, is the one with the least standard deviation. And in this case, we can say optimal project pair of is QS since it offers the lowest risk, right? The optimal project pair, of QS, right? The optimal pair should be is. It's supposed to be using the word is. The optimal pair or project pair is QS since it offers the lowest. It offers the lowest risk. It offers the lowest risk. Any question? Any question there? Any question? So let me give assignment for this. I'm supposed to be seeing someone tackling the question for May 2018. There is a question there. May 2018. I don't know the question number, but there is a question starting with the limitations, stock assumptions for CAPM. So May 2018, there is a question there. We can confirm May 2018. May 2018, let me go back there and I see 1 minute.
Question 2B.
Question 2B. Thank you. Question 2B. That is 1. Then the second question, which I just need you to be able to do, you can be able to try November 2018, and it is good to see those discussions going on in our WhatsApp group. It was formed for that purpose. Question 1C, right? I just need some of you to challenge others to start revising. So November 2018, there is a question there. Question 1C, you can go and try that question. If we have not done it, right? Then we have a question in November 2018 still. November 2018, there is question 4B. November 2018, question 4B. Na swali ikikataa ni vizuri. Swali ikikataa is very well. Since we have not been told we have to be getting everything. Now, I just want us to look on the last thing now, under the portfolio theories. If you think you need to challenge yourself in preparing for the exams, I just need to be to see your workings under the questions which I've assigned you to work on. I just want to do the last part, and we are discussing about someone has unmuted, please.
Natumianga namba ingine, jaribu kutype hii sahi. Nakuanga namba ingine different tumiangi hii sahi.
Someone is having a different
Haina WhatsApp hata sahi.
Mwende, okay. So I just want to do the last part of our portfolio theory and analysis. So in this case, what are we working on? Right, the last part now should be, what? The last part should be portfolio performance measures. Performance measures. So the portfolio performance measures, we say these are the methods used. These methods are used. These methods are used to evaluate the performance. They are normally used to evaluate the performance of the portfolio. They are basically used to evaluate the performance of the portfolio. They normally include, right? Number one, we normally discuss about Shapes measure. And in this case, when we are discussing about Shapes measure, which is normally written like this, SP, Shapes measure, we are saying that it indicates the percentage of the excess returns. It indicates the percentage of the excess returns. It indicates for the excess return generated by the portfolio. Generated by the portfolio. We have said it indicates the percentage of the excess return generated by a portfolio above the risk-free rates. Above the risk-free rates. So now, how does it measure the portfolio performance? We say it uses standard deviation. Normally uses the standard deviation to measure the portfolio performance. Normally uses the standard deviation to measure the portfolio performance. So when we are calculating our Shapes measure, we say to get our SP, we are going to be taking the expected return of the portfolio minus the risk-free rate of return, you divide by the standard deviation of the portfolio. Number two, the second method, we are discussing about Trainer's measure. And when we are discussing about Trainer's measure, it indicates the percentage. It indicates the percentage of the excess. It indicates the percentage of the excess return generated, the excess return generated, right? Generated by a portfolio. Generated by a portfolio over the risk-free rate, generated over the risk-free rates per unit. You can also be able to say, how do you normally measure the portfolio performance? You say, it considers systematic risk. It considers systematic risk. It considers systematic risk by using systematic risk by using beta coefficient. Beta coefficient. So in this case, we say to get our TP, it is normally called TP. So to get our TP, we normally take the expected return of the portfolio minus the risk-free rate of return. We divide by the beta of the portfolio. The beta of the portfolio. Number 3, we are discussing about Jensen's alpha. Jensen's alpha, and we are saying our Jensen's alpha, it assumes that CAPM, it normally assumes that CAPM is accurate in evaluating. It is normally assumed that the CAPM is accurate in evaluating portfolio performance. Portfolio performance. It normally assumed that the CAPM is always accurate in evaluating that performance, and we are saying it uses alpha. It uses alpha. It normally uses alpha to measure the portfolio performance. It normally uses alpha to measure the portfolio performance. So to get our alpha, we normally get the expected return of the portfolio minus SML, right? We know that the SML, it is basically used to measure also the portfolio risk, but it was developed due to the limitations of CAPM. That is the thing that we have done before. So to get a real formula for alpha, for Jensen's alpha, we are going to be taking the expected return of the portfolio minus the risk-free rate of return plus, right, the expected return of the market minus the risk-free rate of return. Then you multiply by the beta coefficient. Number four, we are discussing about Modigliani and Modigliani. We are discussing about Modigliani and Modigliani. It is normally called M squared. And we are saying very well that it uses Sharpe's measure. It normally uses the Sharpe's measure. It is normally used the Sharpe's measure and compares it with benchmark portfolio. And compares with benchmark portfolio. It is normally compares with the benchmark portfolio. So in this case, we are asking ourselves, how do we normally calculate the M squared, right? We can just be able to say, to get our Modigliani or M squared, we are just going to be taking M squared. You just need to take the risk-free rate of return. Then we incorporate the Sharpe's measure formula, the expected return of the portfolio minus the risk-free rate of return. We divide by the standard deviation. Then we multiply by beta coefficient. Beta, the standard deviation of the beta, right? The standard deviation of this is normally called, right? This one. Let me put in that manner. It is normally called the standard deviation of the benchmark portfolio. the standard deviation of the benchmark portfolio. Now, the last thing that we have to be checking here, it is normally called information ratio, is the last method, right? Information ratio. Information ratio. That is our number 5. Information ratio. Information ratio. And we are saying under the information ratio, which is normally also called appraisal. Appraisal ratio. It will basically compare the alpha, compares the alpha. Normally compare the alpha with unsystematic risk. This normally compares the alpha with unsystematic risk, right? That is the information ratio. To get our info ratio, we are going to be taking alpha. You see the alpha here. So you're just going to be taking the answer for alpha, then you divide by unsystematic risk. Unsystematic risk. If the Yoreyote, I think it will not be well understood if we're not going to be doing an illustration. So I just want to do some few questions here to understand how these performance measures are normally calculated. So we are going to be starting with the current question, August 2022. Question number 5A. August 2022, question number 5C. Is not a C, sorry. Our question 5C. So let us go there. August. So when I look at it, advanced FM. And this question, we are going to be doing almost all of it. If you can be able to see it, follow it clearly. So someone read for us. I have not heard from Anne. Anne, can you read for us, please?
The following information relates to the performance of 3 portfolios, A, B, and C, during the year ended 30th June 2022. Portfolio A, average return in percentage 17.55, standard deviation 30, covariance of portfolio return with market returns 0.0088. Portfolio B, average return is 13.26, standard deviation is 34, covariance of portfolio is 0.0750. Portfolio C, average return is 9.34, standard deviation is 28, covariance is 0.0021. Additional information: 1, the market return and the risk-free rate averaged 14% and 7% respectively during the year ended 30th June. Number 2, the standard deviation of the market is 10%. Required, evaluate the performance of the 3 portfolios using Roman 1 is Sharpe's performance measure. Roman 2 is Trainer's performance measure.
Thank you so much. I can see we have to be looking on the computations of the Sharpe's measure, which we have said it normally consider the standard deviation. It uses the standard deviation to measure the portfolio performance. When I look on the question, I can see the examiner is able to give you the standard deviation to assist you in the computations of the Sharpe's measure. I can also see the examiner has not given you the beta of the portfolio, but we can be able to compute the beta of the portfolio using the respective formula, which I'm going to be giving you out. The other thing which I can see examiner has given you, because the bit of the portfolio, it is normally regarded or accepted under the trainer's performance measure. And we have said already, it is normally considered the systematic risk due to the use of the beta coefficient. Now, in that regard, let's start by working on our question. Let us start by working on it. And in this aspect, I have said to be able to get the solution for this, it is important to start by writing your formula for the first one, because the examiner is asking about the shapes performance measure. The shapes performance measure. We have said it is normally written as, we say SP. And I can say to get our SP, we normally take the expected return of the portfolio. That is the thing that we said, minus the risk-free rate of return, then you divide by the standard deviation. Don't forget, we are having 3 different portfolios given by the examiner there. So we are going to be starting with the portfolio A, where we have to be factoring our expected return of the portfolio, which we have been given there straight away as average return. The first one is 17.55. The risk-free rate of return provided by the examiner under the additional information, and we are being told under the additional information 1, the market return and the risk-free rate, which is given as 7%. Then we divide by our standard deviation, which we are being given is half there is 30. I can see for A is 30. We are going to be getting there for B now. For B, we are being given, right, the expected return of the portfolio, 13.26 minus 7, we divide by, when you look on the standard deviation under B, we are being given a 3.4. Then we go for C, right? When you look for C, we are being given as 9.24 minus 7, we divide by what? We divide by 2.8. So how much are we getting here? How much are we getting there? So the first one will be 17.55 minus 7. Then I divide by 30, getting 0.352, 0.352. When you look on the portfolio B, 13.26 minus 7, then divide by 3.4, we are getting 0.184. Then when you look for C, 9.24 minus 7, we divide by 2.8. We get 0.08. 0.08. Those are the answers which you're supposed to be getting under the computation of the shapes measure. You can see how straight and direct it is. But when we go to requirement 2, I can see examiner is asking us to compute trainer's performance measure. Trainer's performance measure. We said it is normally called TP, which you normally get the expected return of the portfolio, the risk-free rate of return, and then we are going to be taking the beta of the portfolio. That is what we are supposed to be checking on. And in this scenario, I can see the examiner has not given me the beta, right? The examiner has not given me the beta. But whether it is given or not, it is not a problem to me, since I can be able to get the beta of the portfolio by taking the covariance, right? Let me start by looking on the asset, the portfolio A and the market. Then we divide by the variance of the market. We divide by the variance of the market. Now, in this scenario, when we start with the first portfolio, which is A, I can see the covariance given by the examiner there was 0.0088. You divide by, and you can see it is given in percentages. It means also the variances, when I look on the variance, it should be the variance of the market, right? Should be how much? Because already I can see no additional information too. We have been told the standard deviation of the market is 10%. So if you take 0.1 squared to get the variance of the market, what are we supposed to be getting here? So it will be 0.0088. We divide by 0.0001. Should be 0.001. I think it should be something looking like that. 0.01, because it should be 2 decimal places. Then we are getting the beta for A is 0.88. Let me go to B now. I can see you are understanding how we normally compute it. The second one will be 0.075, right? 0.075. We divide by, let me now put the variance of the market as 0.01. 0.01. And in this case, I'm getting straight away 7.5. Let me go to C. For C, remember we are calculating the beta of the portfolio. Now for the third one will be 0.0021. We divide by 0.01. How much am I getting here? I can see clearly it will be 0.21. 0.21. Let me now calculate the TP straight away. It will be, to get my TP for A, right? For A, the expected return of the portfolio, which is not going to be changing. It will be 17.55 minus 7. Then we divide by the beta coefficient 0.88. For B, it will be, right? We are discussing about 13.26 minus 7. We divide by 7.5. Then for C will be, for C now I can see is 9.24 minus 7. We divide by 0.21. How much are we getting for each portfolio? So 17.55 minus 7. We divide by 0.88. I can see I'm getting 11.99. The second one will be 13.26 minus 7. We divide by 7.5, getting 0.83. Then for the third one will be 9.24 minus 7. Then we divide by 0.21. I'm getting 10.67. 10.67. Anyone who has not understood? It should be 24. 24 or 34. Let me see. It should be 34. Sorry. This one should be 34, not 24. Someone has not checked that well. So it should be 9.34 minus 7. We divide by 0.21, getting 11.14. Sorry for that. 11.14. I need the answer for that. Then the other one, I can see this one does not have a big variance, and this one, regardless whether it is 24 or 34, the formula will be 0.08. The formula will be 0.08. That does not have any problem. Anyone who has not understood how to get that question out, how to work that question out? Anyone? Anyone? There is another question I just want to do. May 2017 question 2B. Mimi sina wakati wa kufanya kianga watu wakisema tufanye block release. Let us do all the questions here right now. When you go to those videos, you have all the questions with you and the solutions. So in this case, we are just looking for May 2017 question 2B. Question 2B. May 2017, we have question 2B there. So let us go there and we look on now that question should be solved. We look on 2017. We are discussing about May. Okay. So the question is here. Rose? Rose, go on. Rose, kindly.
The following information relates to the performance of 6 portfolios over a 7-year period. We have the portfolios, the average returns in percentage, standard deviation of the average annual returns in percentage, correlation with market returns. For portfolio B, we have 18.6%, 27.0% as the annual return, and 0.81 as a correlation with market returns. Portfolio Q, we have 14.8%, 18.0%, and 0.65 as a correlation. Portfolio R, we have 15.1%, 8.0% annual return, and 0.98. Sorry. Portfolio Q, we have 14.8% as the annual return, 18.0 as the annual return, and we have 0.65 as the correlation with market returns. Portfolio R, we have 15.1% as the average annual return, 8.0 as the annual return in percentage, and we have 0.98 as a correlation. Portfolio S, we have 22.0% as the average return, 21.2 as the annual return, and 0.9 and 0.75 as the correlation. Portfolio T, we have negative 9.0 as the average return, 4.0 as the annual return, and 0.45 as the correlation. Portfolio U, we have 26.5 as the average return, 19.3 as the annual return, and 0.63 as the relation. Market return as 2.0, risk-free rate 9.0 required. Rank the performance of the above portfolios using first Sharpe's method and second Trainer's method. Then C,
Thank you, Rose. I can see part C, we are being told compare the rankings using the two methods in B above and explain two reasons behind the differences. I will be able to give that. I can see the Sharpe's measure. We said Sharpe's performance measure. We said it normally appraises the standard deviation. The other one normally appraises the beta coefficient. Now, when we have these problems, I can see the examiner has not given me the beta coefficient, has not given you the beta coefficient, and also you don't have the covariance. Remember, you don't have the covariance as we had from the previous question, but that does not data has from calculated. Because we know the formula to get the covariance, we can just equate it directly. But when you look on the Sharpe's measure, it does not have much problems. Let us go to the board and we see what is required of us. Now, in this case, we know very well when we are starting with the Sharpe's measure or Sharpe's methods, we said to get our SP, we normally get the expected return of the market minus the rate of the market of the portfolio minus the risk-free. We divide by the standard deviation. We divide by the standard deviation. Now, in this case, the question of ours is given under the respective portfolios. We have portfolios here. Portfolios, right? Given straight away there. Then we have our formula. Let me just bring it closely because I don't want to write the formula again. Portfolio given there. Then we have our formula there. Then we are going to be doing our ranking because already we have been told, examiners told us that, let me look on the question, please. We have been told rank the performance of the above portfolios using. So we are going to be ranking our projects here. So in this case, we are going to be starting with the respective projects. We start with P, but this formula I'm just going to be using for the portfolio P. I can see we are being given the expected return of ours is 18 because we are being given the average annual returns, which should be 18.6 minus the risk-free is given down there is 9. Then we divide by 27, which is our standard deviation for portfolio P. So in this case, I just want to take it directly. So it will be equal to how much? 18.6 minus 9. We divide by 27. I'm getting 0.36. Can I take 3 decimal places? Yes, like that. Then after P, we go to Q. So we know very well up here will not be changing. What is going to be changing is our standard deviation. So I just say 18.6 minus 9, which is 9.6. I divide by the standard deviation of Q will be 18. I'm getting 0.36 0 point. How much are we supposed to get it down there?
Excuse me,
Yes.
excuse me, just a minute. The expected return for Q, it's supposed to
14.6,
change.
correct.
Yes, not
14.8, sorry,
Oh,
minus 9, correct now. We divide by, that was wrong, 18, getting 0 point, it should be 0.322. Q, we go to R, and our R I can see, the expected is 15.1, minus 9. We divide by 8, getting 0.763 RS. Then on our S, we can be able to take 22 minus 9. We divide by, I can see it is 21.2, getting 0.613. 0.613 S U, right? When you go to U, ST, sorry, easy. ST. So for our T, I can see it was -9, right? Minus 9. Then you divide by, right? We divide by 4, getting -4.5. Then you go to U, TU. I can see our U is 26.5 minus 9. Then I divide by what? 19.3. Getting 0.907. Sasa hizi ni rahisi sana. Who can compute this? This seems very simple, right? Sisi tushamaliza already, we have 4 marks. But I can see trainer's measure is having more marks than this one. Let us look what is the problem with it. Right? Let us look what is the problem with it. So we know already we are using trainer's method, and we say to get our TP, just write the expected return of the portfolio, the risk-free, divided by the beta of the portfolio. And in this case, we know very well this one is not given. The covariances are not given. So which formula are we going to be using here? Take your portfolios out, right? We do our portfolios, right? Let us get our beta coefficient first by taking, I said it, if they are not given, take the correlation coefficient between the portfolios and the market. So let's start with the first one, which is P and the market, right? The P and the market. We multiply by the standard deviation of the portfolio, then we divide by the standard deviation of the market. The standard deviation of the market. So when the covariance is not given, don't panic. That is another formula, you can be able to get it. Then we know very well to get our TP, we said take the expected return of the portfolio minus the risk-free rate, you divide with your answers which you have generated there. Then we rank at the end of the day. We were not able to rank the others. We'll be able to repeat that. Now, from that aspect, we are going to be starting with P. They just write for P alone. So when I look on the covariance between correlations with the market returns, I can see the first one was 0.81 for P. We multiply by the standard deviation, which is 27. We divide by the standard deviation of the market, which we have already given down there, S12. So how much are we getting? 0.81 times 27. Then I divide by 12. Here we are getting 1.823. Then the other one, P, right? PQ. Under Q, we are going to be looking on the standard deviation of that respective portfolio with the market. I'm getting 0.65 times the for the other one, the standard deviation, which is 18, divided by 12. How much are we getting there, Lillian? Times 18 divided by 12. 0.975. Q, we are going to R now. To get for R, I can see we are going to be taking 0.98 times, right? We are discussing about 8. Then we divide by 12. We divide by 12, 0.98 times 8, divided by 12, getting 0.6 653. And S, when you go to S, how much are we getting down here? For S, we are going to be taking 0.75. We multiply by, right, after 8 is 21.2, divide by 12. 0.75, we multiply by 21.2, I divide by 12, getting 1.325. As we go to T, right, when you go to T, I can see we are taking 0.45. We multiply by the standard deviation of the portfolio given in the question there. It is 4, sorry. Then you divide by 12. How much are we getting here? 0.45 times 4, we divide by 12. I have been told is 0.15. Then the last one, the last portfolio will be U, which you are going to be taking how much? For U, you take 0.63. 0.63 times 0.63, we multiply by what? I can see we are multiplying it with, is it 19.3? It should be 19.3. We divide by 12. We divide by 12. How much it is? 0.63 times 19.3. We divide by 12. And I can see we are getting 1.013. 1.013. Now let us go and compute our trainers method. And then using the trainers method, let us get our trainers. So in this case, we say, let me take the expected return of the portfolio. We were able to get 18.6. 18.6 minus the risk-free rate of return given as 9. Then we divide by 1.823. So 18.6 minus 9, you divide by 1.823. I'm getting 5.27. 5.27. 5.27. The next one will be, right? We have said the next one will be 14.8. Minus 9, divided by 975. How much am I getting there? 14.8 minus 9, you divide by 0.975. I'm getting 5.95. The next one will be, after 14.8, we have 15.1. Minus 9, divided by 0.653. How much am I getting? 15.1 minus 9, I divide by 0.653, getting 9.34. The next one will be, after 15.1, I can see it is 22 minus 9, we divide by 1.325. 22 minus 9, I divide by 1.325, getting 15.21. 15 points, is it 15? There must be something wrong there. 22 minus 9, then I divide by 1.325. It should be 9.81. 9.81. The next one will be, after 22, should be negative 9. Minus 9, divided by 0.15. How much am I getting? Negative 18 divided by 0.15. I'm getting negative 120. Then the last one will be, right? The last one will be 26.5. 26.5 minus 9 divided by 1.013. 0.013. How much am I getting there? Minus 9 divided by 1.013, getting 17.28. Then you do your ranking here. Let us rank from the best to the worst. So in this case, this one is the best. This one is number 1. The second one, I think it should be this one, 2. This is our 3. This should be 4. This is 5. This is 6. That is 6. Remember, for the other one, right? For the ships SP, you are able to get what? For the SP, we were able
Sorry,
to get...
excuse me.
Yes, yes.
Could you explain the criteria you're using to rank or what you're considering?
We are ranking from, remember, we are ranking from the best to the worst. And in this case, the criteria which is basically used, because here we are looking on the portfolio performance. We said we basically look on the returns which are generally generated from the comparison with the risk-free rate of the return. So in this case, when we are looking at it, because we are looking on the portfolio performances, we look on the portfolio which is giving you the highest return. So this is performing better compared to the others. That's why we are giving it number 1. Is it okay?
It's okay.
Yes, yes. These are performance measures, how the portfolios are performing. Just take from the best to the worst, best to the worst. So this one we got, let me clear here. So that I remember I was not able to rank for SP. So when you look for SP, right, we were able to get, the first one was 0.356. The second one was how much? 0.322. The third one was 0.763. I think these formulas might be, the answers might be differing. 0.613. I don't know. They are not. They are okay. 0.907. So when you're ranking, take the best. This is number 1. Ranking for SP. This is performing better, number 1. Number 2 should be 76. 3 should be how much? 613. This is number 3. Number 4 should be 35. This is 5 and this is 6. They should be looking like that. So the causes of the difference in ranking, and that is a question asked under the part C. The question is difference in ranking, right? The causes. You're being told to the cause of difference. The cause of difference in ranking. Don't overthink. Just say this. Shapes methods uses standard deviation. Normally uses the standard deviation, while Trainer's method uses beta factor. While Trainer's method uses beta factor. You can give another a factor, the cause. Shapes measure or Shapes method. Shapes method considers total risk. Normally consider the total risk, while Trainer's method considers systematic risk. This normally considers systematic risk. Those are the differences in the analysis given there. The differences in analysis which you have to be giving out for the differences in your rankings there. For the differences. Any question? Any question up to that point? Any question? I just want to hear from you. Nobody is having a question. Can I do the last requirement? Yes, I can do not the requirement, but assign the question. I can do the last question for that topic, and then I just give you more questions for you to try your luck. Right? The last thing. November 2017, question 2A. Don't wonder at mwalimu hataki tukilala. No, just want us to push. So we are looking at November 2017. And we are doing a lot of questions. I'm expecting my student to pass. It should be question 2A. Which question is this? Is it 2A? No. It should be 2 something, 2C. 2C? Somewhat reads. Somewhat reads.
Nikesa Investment has initiated an investment.
Who is reading for us, please? Let us save time. Godfrey, good evening.
Good evening, Madam.
Go on.
Okay. Kesa Investment has initiated an investment fund called FIDICA, the funds of which will be invested only in stocks and bonds of infrastructure and construction companies. 60% of the fund value is invested in companies engaged in commercial construction services, and the other 40% is in companies engaged in developing residential properties. The average rate of return from development of residential properties is 1.9, and that of commercial construction services is 1.4. The benchmark market return is 11.2%, for the treasury bonds carry an interest rate of 4.25%. The following information on the asset value per share is provided. There is a month and then there is January crossing at value of 18.80, March has 18.20, April 18.80, and June 16.80. Dividends only have February, which has 0.75, and June, which has 1.20. July has 1. August it has 17.80. September has 17.90. October has 18.0. November 18.8. November has 18.80, and December has 18.50. Even period for those months, it is none. The opening net asset value of for January is 17.75. Click and calculate Jensen's alpha relating to FINDICA and use it to evaluate the fund performance.
Thank you. I can be able to see we have been told to calculate Jensen's alpha relating to FIDICA. And you're going to be using it to evaluate the fund's performance. Now, in this case, we can be able to see that the Jensen's we said it uses, right? We said our Jensen's is able to use what does the Jensen's use? We said Jensen's, it normally uses alpha to measure the portfolio performance. And we are already be given some data there. And since we don't have the beta or the weighted beta, it is easier for us to be able to calculate. Since we said to get our alpha, we just need to be taking the expected return of the portfolio minus the security market line, So let us look on our board and we see what is being required of us to be able to do this kind of a question. Let us see. So when I'm looking on my question there, a minute, please. One minute. Thank you. Now, I can see here, we have been told to calculate the Jensen's alpha, and we say to get our alpha, we just need to be taking the expected return of the portfolio minus SML, minus the SML. And we said our SML, to get our SML, we normally use the CAPM formula. We said, let us use the risk-free rate of return. We multiply by the expected return of the market by the risk-free rate of return. Then we multiply by the beta coefficient. So it means the formula to get our alpha should be equal to the expected return of the portfolio minus the risk-free rate of return plus the expected return of the market, risk-free rate of return, then we multiply by the beta coefficient. Now, remember in the question, I have not seen anywhere where the examiner has given you the beta, but we can be able to get it by taking the weighted beta. How am I going to be getting this? There is a statement which reads, I can see we have been told 60% of the fund's value is invested in companies engaged in commercial construction services, and the other 40% in the companies engaged in developing residential properties. So the average beta of returns from the development of residential properties is 1.9, and that of the commercial. So in this case, you can see, right, the other one for the commercial. So in order to get the weighted, I just need to be taking 0.6. I multiply by the beta for the commercial construction, which you have been given as 1.4, plus 0.4. I multiply by how much? I multiply by 1.9. How much am I going to be getting the beta, right? The way I'm going to be getting the bit of the my portfolio in this case. So to get it, I just want to take 0.6 times 1.4 plus 0.4 times 1.9. I'm getting 1.6. 1.6, right? 1.6. Then in this case, once I get my beta, to get my Jensen's, I just be taking the expected return of the portfolio, in our case there, right? The expected return of the portfolio, we have been given how much? Let me check down. Let me check down there. The expected return of the portfolio is how much? shall be able to consider it later. But when you are calculating your SML, let's first calculate our SML. To get my SML, before we go there, we can take the risk-free rate of return, right, plus the expected return of the market minus the risk-free rate of return, then we multiply by the beta coefficient. The risk-free rate of return, I can see there is a somewhere where we are being told the benchmark market return is 11.2, right? While the treasury bonds carry an investment rate of 4.25. So you just need to take 4.25 plus the expected return of the market being given 11.2, right? Minus the risk-free rate of return, which is provided as 4.25. You multiply by the weighted beta, 1.6. Now, in this case, I just say 11.2 minus 4.25, then I multiply by 1.6 plus 4.25, getting 15.37%. So what else after I get the 15.7%? Now, this does not mean it is the end, right? It is not the end of the question, since we are not given the expected return of the portfolio. The expected return of the portfolio, we can be able to take the summation, the expected return, we can take the summation of returns. Am I going to be getting the expected return when I'm considering things which we have been told they are called the net asset values per share? So in this case, to get your returns here, to be able to get your returns, you just need to be taking the percentage change of prices, the percentage change of prices, or let me use a simple term here, in prices, which you are going to be taking, right? We normally discuss about new minus old plus your dividends. Then you divide by old, you multiply by 100%. This is the formula that you're going to be using to get the solution for the question there. Now, in this case, we are being given a lot of months here. So it means I have to be clearing some space here. Right? We have to be clearing some space there. So here I'm discussing about months. We have our month there. I can also look on the returns. Our returns, we can be able to do them here, where we have said, take your new, subtract your hold, add your dividends, divide by your hold, then you multiply by 100%. Multiply by 100%, right? We multiply by 100%. That is how we are going to be getting the answer. Now, in this case, I can see the examiner is giving us some few new terms which are not in our formulas. I can see he's saying you have your closing, right? We have our opening. So in this case, if for example the new is our closing because it is our current it is the current situation we are in. This is our closing. Your old should be your opening, right? Because we are being given two things here. We are only being given two scenarios here. We are given the new, we are being given the closing stock, we are being given the opening, right? The opening net asset value, sorry. Now, in this case, since we want to calculate our returns, let us do for every month. We start with January. The return for January, we can see the closing for January is how much. The return for January we are being given, the closing we are being given 18.6. Sorry? Someone was arrived. So 18.6, you can see we are being given the opening of the net asset value is 17.75. In January, we don't have any dividends. Then we divide by, right? We are discussing about our opening, which is 17.75. Then we multiply by 100%. So how much are we getting here? 18.60 minus 17.75 divide by 17.75. Then when I multiply by 100, I'm getting 4.79%. Right? Then we go to Feb. Our Feb will be how much? I can see under Feb, we have our dividend. So it will be 17, right? 17.80. Someone should be muting, please. Right? I've said 17.80 minus our dividend, our opening, which is 17.75, plus our dividends. I can see our dividends 0.75. We divide by, right, our holds, right? Our hold in this case should be the opening for January. The closing for January should be the opening for February. That is the thing that I just wanted to capture. The closing stock for the closing net asset value for January will be the opening now in our scenario here. So this should be 18.6, sorry. Kamau will kick you out, please, just mute. So I have said 17.8 minus 18.6 plus 0.75, you divide by 18.6. Then you multiply by 100%. Multiply by 100%. So how much is this? 17.80 minus 18.6 plus 0.75. You divide by 18.6. 18.6. I can see I'm getting negative 0.27. Negative 0.27%. Mo does not want to mute. Now for March, right? When I look for March I can see the closing stock is given there, 18.2 minus, now the closing stock for February should be the opening for March, which is 17.8, right? And I can see under March we don't have dividends, so no problem with that. Then we divide by 17.880. Then this one we multiply by 100%. So how much it is? 18.2 minus 17.80. You divide by 17.8. Then you multiply by 100%, getting 2.25. March, we go to April. April, you do the same. We are being given the closing, right, of 18. The opening of our March was 18.2. Right? Do we have dividends for April? No. Then we divide by 18.20. Then this one we multiply by 100%. So 18 minus 18.2. Then you divide by 18.2. Right? We multiply by 100. We should be getting negative 1.098. It should be 1.10%. Negative 1.10%. Then when you go to April, May, when you go to May, it should be 17.80 minus, right? For April, we were able to get 18. Do we have dividends for May? Yes. No, we don't have. Then you divide by 18. You multiply by 100%. Multiply by 100%. 17.80 minus 18, right? You divide by 18. Then you multiply by 100%, getting negative 1.11%. Then May, June. When you look for June, I can see we had some dividends. So in this case, it will be our closing, which is 16.80, right? Minus our dividends, our opening, sorry, which is 17.80, plus our dividends, which is 1.20. We divide by how much? 17.80. Then this one you multiply by 100%. How much are we getting? So 16.80 minus 17.8 plus 1.2. Then you divide by 17.8. I multiply by 100. I should be getting 1.12%. 1.12%. After June, we go to July, right? For July, we are going to be having what? July, I can see we have 17.20. Take your closing, the opening for the opening for July, which is 16.8. You divide by 16.80. Then you multiply by 100%. How much are we getting here? 17.20 minus 16.80. We divide by 16.80, right? Getting times 100, getting 2.38. 2.38. July, we have August. Under the August, I can see we are supposed to be taking 17.80 minus 17.20. You divide by 17.20. Then this one, you multiply by 100%. How much am I getting at the end of the day? Should be 17.80 minus 17.20, right? You divide by 17.2. Then I multiply by 100, getting 3.49. 3.49. August. We go to September. Under September, I can see we have 17.9 minus 17.8. We divide by 17.8. How much am I getting here when I multiply by 100%? This one should be 17.9 minus 17.8. We divide by 17.8. When I multiply by 100, I should be getting 0.56%. September, we have October. October, under the October, I can see we have 18.10. Take your opening, 17.9. We divide by 17.90. Then this one you multiply by 100%. So we are taking 18.1, right? Minus 17.8, 17.9, sorry. Then I divide by 17.9 times 100, getting 1.12. We go to November, right? Our November should be how much? We are talking about 18.80. I look on my opening, which was the closing for October, 18.1. I divide by 18.10. This one multiplied by 100%. How much am I getting also there? So 18.80 minus 18.1. You divide by 18.1. Then I multiply by 100%. I'm getting 3.87%. November, we have December. Under December, we need to be taking 18.50. Take the opening there, 18.80. Take your opening, which is also, you think it should be 18.80. Divide by 18.80. Multiply by 100%. Have I taken the correct data? It should be 5. This one should be 5.
18.5.
Correct. So 18.50 minus 18.8. Then you divide by 18.8, getting that, and then you multiply by 100%. I can see I'm getting negative 1.60%. 1.60%. 1.60%. 1.06%. So how much are we supposed to be getting the total? So the total of your percentages, 4.79 plus negative 0.27 minus 2.25. Let me repeat, 4.79 minus 0.27 plus 2.25 minus 1.10 minus 1.11 plus 1.12 plus 2.38 plus 3.49 plus 0.56 plus 1.12, right, plus 3.87 minus 1.6. 1.60. I'm supposed to be getting the total down here. The total returns should be equal to 15.5%, right? So in this case, we know very well when we are dealing with the sample data, right? When we are dealing with the sample data, which is less than 30, is it less than 30? Yes, we know that. What are we supposed to be doing? Is it less than 30 or more than 30? Let me see. So our data is more than 30. So in this case, it means if I want to get the expected returns, I'm going to be taking the summation of returns. I divide by n. So in this case, it means I just take 15.5. I divide by, right? I divide by n, which is 12. This n, it is more than 10. So sorry. So in this case, it means how much am I getting out of this? How much am I getting out of this?
Excuse me.
Sorry?
I have a question.
Yes.
How have you known that the sample is more than 30?
Let me just check on something. 1 minute. Let me check on something, please. A minute. There's something which I'm not getting clear there. I think I can for this one, because what is remaining is very small thing to get our alpha. I just want to go and check on it. I'll just be able to explain in our WhatsApp group for now. We are supposed to be concluding from here. Because already I just want to be checking on that data size, whether I'm using n-1 or I'm supposed to be using n. But the calculation is okay up to that point. Let me just do the alpha, because what we just require to get my alpha, we said take the expected return of the portfolio, then we subtract our SML, which we are able to get something equivalent to 15. Was it 15 point something? It was 15.37%. So I just be able to give out the clarification, maybe even some few minutes later, or now you're supposed to be getting your alpha and make your decision there. Now, because that one I will be able to conclude in our WhatsApp group. The assignments that you're supposed to be checking on, there is a question for September 2021. September 2021, there is a question there. A question which starts with the assumptions of portfolio theories. There is a question there for September 2016. There is also a question, not 2016, but September 2021. Then we have a November 2016. November 2016, we have question 2B. Question 2B. November 2016, question 2B. We can be able to gauge the two questions, and we look on now we can be able to compute the answer for this. This one, I will be able to clarify this in the next few minutes after our class, after the conclusion of our class. Then you will be able to know how to work with it. But the biggest parts you have already known on how to work on it. Is that okay?
Okay.
Thank you very much. That does not have any problem. We are not going to be, there is a conclusion because we have done with the portfolio theories. When we are meeting tomorrow, we are supposed to be doing advanced financial decisions as our topic 3. Advanced financial decisions as our topic 3. If we don't have any queries, then we can stop at that point and see you tomorrow. See you tomorrow. Is that okay?
Okay.
Yes.
Thank you. Let me wish you good night.
Good night.
And see you tomorrow.
You too.
Bye-bye.
Bye-bye.
Bye.